cars to crude, West Texas Intermediate for June delivery plunging nearly 30% today to about $12 a barrel as storage continues to fill, and Diamond Offshore becoming the latest oil firm to file for bankruptcy. For more, I'm joined by Spencer Jakab. He's editor of the Wall Street Journal's Heard on the Street. Spencer, it's great to see you. You've done a lot of really good work on what's happening across the oil patch. What does Diamond's bankruptcy filing tell you?
It's not going to be the last one. The oil field services space in particular is going to feel the squeeze right now. Those are the companies that have the equipment and lend the picks and shovels. And Diamond Offshore was an offshore company, but companies that frack the wells, that provide the sand, that provide the horsepower for hydraulic fracking, they're all in a world of pain right now. And as much as oil producers are feeling the pain, they are seeing just a huge plunge in activity in North America in particular. And a lot of the companies that were already close to the edge, Diamond Offshore was already a kind of a tricky credit, just went over. It won't be the last for sure. How
big could it get, Spencer? We've spoken with an analyst in the past who says he wouldn't even rule out a merger between Chevron and ConocoPhillips. I mean, these are kind of the biggest of the big names. Others have said they actually think companies like Exxon could be hurt more than the smaller ones because the scale of their losses is so much larger because they're just simply so big. So, should we bet on the energy industry looking more or less like it does, getting through this, but just losing the smaller players, or could it be fundamentally reshaped?
I think, Exxon is a very strong credit. Chevron's a very strong credit. You have some weaker credits among the smaller companies. I think what you're going to see not is a sort of a desperation move, but what you're going to see is the Exxons and Chevrons of the world taking advantage of this and buying companies and snapping up assets that they normally wouldn't have been allowed to snap up. And a crisis is great camouflage to come in and do things like that. It's not to say that they're not going to be hurting a lot. All of their assets, from refining to chemicals to oil production, not just in the U.S., but all around the world, is hurting in this situation. Their production is going to decline because there simply is no place to put the oil in a lot of parts of the world. But they're going to come through on the other end of this, not stronger, but relatively speaking, stronger, because a lot of smaller players just aren't going to, to be able to keep going.
No, I love how you put that the crisis is great camouflage for the kind of M&A that ordinarily wouldn't be allowed. Before you go, you've talked about the fund that ate the oil market, so to speak, the problems with USO. What's your takeaway there?
So, you can't stop people from doing dumb things. Owning USO, apologies to anyone who owned it for any period of time. There have been swaths of time when you could have made money with it, but it's not a very well-designed product. It is something that allows mom and pop or funds that can't own futures to play in the oil market. But USO now realizes how close it came to the edge, and it's changed its holdings. It's changed its holdings a couple of times. It owned as much as 30% of the June WTI contract, which is a huge position. And it's now moved its positions farther out the curve because as you get closer and closer to expiration of the futures contract, the danger that you get stuck actually having to
take that delivery, right?
Yeah, accelerates. And so that's what happened to them. They didn't own this May contract, by the way, that went to negative $40 last week. But they did own a lot of the June contract that also fell a lot. And so everyone knows that they're a seller in the market. Yeah. And that is adding to the pressure. And they're not the only ones, by the way. You have for example, a lot of Chinese wealth management products that also blew up, that also WTI contracts. So they're not the only kind of, game in town. But as you get to very, very close to the tank tops in places like Cushing, Oklahoma, where the contract settles, you're going to have stuff like that happen.
Spencer, it's great stuff, and I'm so glad to see you again. Spencer Jakab is the Heard on the Street editor for the Wall Street Journal.